Next topic we're going to cover is the security market line. And here we've got to use the chart because there's a little picture that I want to show you. We've been speaking about this notion of risk premium and required rates of return. There is a very much direct relationship between risk and return. In the case of the security market line, the definition of risk is actually beta. Beta being a representation of the inherent risk in the market, equity market risk overall. And the higher the beta level, which is indicative of a higher level of market risk for a given security or a given stock, so the more risky stocks would be the higher beta stocks, like the high-tech stocks, for example, investors require a higher level of expected return. And the security market line, again, it's a line, straight line going up, intersecting the y-axis at the risk-free rate. Obviously, with no beta risk, all the investors require, by way of compensation, is a risk-free rate of return. And as you move out and take on more beta risk and invest in higher risky securities, higher risk securities, you expect to be paid a higher return. And that, in essence, is a security market line. It's a line that indicates the required return for a given level of beta risk for each individual security. And in theory, if securities are priced appropriately, the lower risk securities, the lower beta ones, the more stable stocks that might, for example, be in the utility sector, would have lower beta values and would be priced appropriately and lie on the line and give you an appropriate return level at that point. The higher beta stocks, like, for example, biotech stocks, would be out here on the beta spectrum and would give you a higher expected return on that line. You'd run up and run across. The equation that really drives the security market line is known as the capital asset pricing model, CFA. And that equation is as follows. The expected return on any stock is made up of two components. Again, an investor requires to be compensated at the risk-free rate, and they expect to be paid a risk premium. And that risk premium is based on the beta of that stock times the market's risk premium. So for a beta of 1, this beta would just be 1, it would fall away, and you would get risk-free plus market return minus risk-free. These two would cancel, and you'd be left with a market return. For a higher beta stock, this item, say if beta was 1.2, for example, this item is going to magnify up and give you a higher expected return. For a low beta stock, the opposite is true. So this is a very important equation. I mean, this is almost certainly going to come up in the exam. And by all means, memorize this equation, write it down many times, and make sure, we'll go through an example later on, but make sure for given levels of risk-free rate and beta and market risk, you can compute the implied expected stock return. Now, how does the security market line change? The next topic calls for us to look at potential changes in that security market line. And if you've covered another area in level 1 already around debt instruments, fixed income, you may have read that the yield curve, which is a curve that indicates different levels of interest rates along different points in the maturity spectrum, moves parallel and can twist and move up and down and twist around its current level. Well, similarly, the security market line is not a fixed-in-stone line. I mean, it's a line that can change through time. Let's have a look at a couple of changes that could happen with this line. The first one is that the slope of the line could change. The slope of the line is actually this beta item. And as people's attitudes towards risk change, as they require more compensation for taking on more risk, they would expect a more steep line. And what that means is that biotech company that was previously giving you a return at that level now has to move up and give you a return at a higher level because people are more nervous. And that would have happened more recently with the meltdown in the market that we saw in the early part of the century and the collapse in the NASDAQ. What we experienced there was people's attitudes towards risk were changing. And if you're going to buy a biotech company, you better be compensated for taking on that risk. The other change that can happen to the security market line is just like a yield curve, it can shift parallel. And here I'm using this little dotted line to indicate a parallel shift downwards. That would occur because of changes in economic factors, market factors. Not so much change in risk factors, but changes in some fundamental factors in the market that just change people's required returns. For example, a change in the money supply. That can lead to changes in interest rates. It can lead to changes in the general level of returns that people require in the market, and that's going to be an indicator of a parallel shift. Obviously, this parallel shift could happen up or down. I've just, in this case, referred to a shift downwards, but obviously a shift could occur in the other direction as well. The next topic calls for us to discuss the portfolio management process. And even though we're in level 1, a lot of the material we're about to cover is actually very much covered in detail in level 3. Level 1 obviously requires you to only have an overview level of knowledge. But we're going to discuss a very fundamental issue or concept that is faced by all investors, be they private investors, be they institutional investors. And we're going to go through some of the basics around how do you manage a portfolio? How do you go from A to Z, as it were? I'm going to go to the slide now to show you the dynamic process that takes place. Firstly, there's planning. Before we get into the details, let's just cover it at a high level. Planning, executing, and then feedback and monitoring. As part of the planning stage, investors, all investors, no matter who they are concerned about what they're trying to do. What are their goals? What are their objectives? What are they ultimately trying to get out of the management of their money, of their investment program? And that's typically identified by a rate of return requirement. Are there any constraints? Are there any barriers or limitations that need to be factored in respect of the way they build their program? What is their attitude towards risk? What are their risk preferences? And finally, what are they expecting in general in the capital market? Capital market expectations. These items change through time. Certainly, if you think about it from a simplistic standpoint, people's attitude towards risk change. People's limitations, and that really feeds into risk. Their constraints might change. What they're trying to achieve in their investment program might change as they get older, for example. And what we expect out of the capital markets is obviously a dynamic, fluid movement. So all of these items are dynamic. And the planning process, while it might be executed this year, may have to be revisited. And a lot of these inputs might change a couple years out, 3 years out. Once you've gone through all of this and you have a good sense of what an investor's aims and objectives are and how they're limited, what their risk attitude is, what we expect from the market, we can build an asset mix. An asset mix, obviously, that makes sense, given all of those items we've been speaking about before. And that asset mix drives most of the behavior of that portfolio. So in the execution stage, when you're going out there and building the portfolio and hiring managers, you've chosen which asset classes you're going to invest in, you've built the asset mix. You've built the building blocks and the fundamental, the cornerstone of how your portfolio is going to behave. It's going to explain how your portfolio is going to behave. Having done that, you move to the final stage. And the final stage is really a feedback stage. Given that you've decided upon an asset mix, which might be, say, 50% in equities and 50% in bonds, you're going to want to rebalance that. You're going to want to make sure that as your asset mix moves out of the 50-50 position because of market movements, that it's brought back to 50-50, because that was the investor's intent. And you're going to want to monitor as well, make sure that the managers you've hired are delivering as expected, the portfolio is delivering the type of returns required, given the objectives and the constraints and the attitude towards risk, that it doesn't look to be too risky or not risky enough, that it still makes sense given the capital market expectations, and you're going to provide feedback. And that feedback is going to go back into those 4 key planning inputs, again in a dynamic way, which might change the asset mix and lead to a new execution, lead to perhaps a reconfiguring of the portfolio, and ultimately, again, another analysis, another level of feedback.